Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. Your weekly fix of local and international news for investors and traders alike. These are the stories that really caught my eye in the past week. We kick off Supernatural Stocks this week with gold, and gold is theoretically an inflation hedge and a safe haven, although I did learn the hard way during the pandemic that doesn't always seem to be the case when interest rates are low. In those conditions, people were more interested in growth assets rather than safe havens, regardless of inflation. I bought into the sector too early and then got increasingly frustrated as gold did nothing, even as inflation came in. Then, as rates started to rise, I thought gold might finally react to inflation. And it didn't. In fact, it laughed at me and all the other gold suckers at the time as investors rather went in search of yield. And sadly, the yellow stuff doesn't pay a yield. With some change in personal circumstances, I finally gave up at what turned out to pretty much be the bottom of the gold cycle, and I swore never to touch the stuff again. Of course, gold started rallying like crazy after I gave up, to the levels we are seeing today. And I've now put gold in the dark arts bucket, and I've accepted that it's not for me. But this doesn't mean that I don't find the old debate of the commodity versus the mine very interesting. The commodity, i.e. buying gold itself, takes out all of the noise of mining-related issues, but it does forego the operating leverage benefit of a well-run mine. Perhaps the best way to look at this is to compare the gold price to a few locally listed miners to see how they've done. Now, a practical way to do this is to take a JSE-listed gold ETF, like, for example, the One Invest Gold ETF under the ticker ETF GLD, although there are a few you can look at. The year-to-date performance on that ETF is a return of 14%. Over 12 months, it's up roughly 14% as well. So the action really has been since January. Now let's look at Harmony Gold, which is a wonderful example of a mining house that is really getting things right at the moment. Year-to-date performance is 47% at the time of recording, and the one-year performance is 75%. So that is way higher than the commodity ETF. Goldfields, now that's a good example of underperformance, and if you've been following the recent announcement, you'll know that. It's achieved a 17% return this year, surprisingly ahead of the commodity despite the challenges, but only a 2.5% return in the past 12 months. Now what this analysis is missing, of course, is the dividend yield. As I pointed out earlier, the commodity itself doesn't pay a yield, but of course mining houses do. At both Harmony and Goldfields, you could add a couple of 100 basis points to the story in terms of dividend yield. Now, if we kick it wider in the sector in terms of listed companies and longer in terms of time period, we find that the gold ETF would have returned a total of 135% over the past 5 years. That gets dwarfed by even the sector underperformer Anglo Gold coming in at 178%. Then Pan-African Resources 250%, before we get to big hitters Goldfields at around 500% and Harmony at over 640%. The lessons here? Over a long enough time period and provided you buy a basket of miners, it seems like they can give better returns than the commodity because of the operating leverage in the system. Another lesson is that gold is very much a buy and forget type of investment, and hence the mining stocks should really be treated the same way. I made a mess of it with my gold attempts over the past few years and trying to be far too cute with timing the market in that sector. And finally, I think we have gotten to a point where the large gold groups are diversified enough and have consolidated enough that a lot of the single mine operating risks have been managed, although the negative production surprise at Goldfields in the latest quarter might suggest otherwise. Still, if you go and you buy a basket of the stocks, especially the big names, you really are mitigating so much of the operational risk in this sector. Renergen is just the most wonderful example right now of bulls and bears fighting it out. I have no horse in this race myself. I just enjoy watching investors slug it out over a particular stock. We don't see enough of this in South Africa. Now, Renergen is of course particularly good for this purpose because it is such a polarizing stock. This really is the Marmite of the local market, with equal amounts of passion on both sides of the fence. Bulls are focusing on the future, with the potential for Renergen to add some much-needed diversity to what comes out the ground in the Free State by producing helium, a valuable gas with many applications beyond just the balloons at your kid's party. It's not easy to get to that point, and Renergen has the unenviable task of building in public. This is a tightrope for the management team, as they need to tell a highly optimistic story in order to attract investors, but in the process they make themselves soft targets for naysayers. Of course, what really doesn't help is when there are operational issues that call into question whether the project will ever be a success. We've seen some major teething issues with the equipment that has caused delays to Phase 1 helium production, as well as disruptions to the LNG side of the business. Other recent irritation on social media has been focused on elements of the newly released financials, particularly capitalization of certain costs rather than expensing them. My view on this is a bit simpler. Renergen is essentially a binary outcome. The success or failure of the story has very little to do with the current levels of LNG coming out the ground or the exact timing of helium phase 1. If you're buying shares here, you need to have looked all the way out to around 2027 when the big helium projects are expected to be a reality, while considering your dilution as a shareholder along the way. And therein lies perhaps the biggest issue here. A large proportion of Renergen investors didn't do this work at all. Hype stocks attract punters who don't understand what they are truly buying into, particularly in junior energy stocks where the only real guarantee is that there will be vast dilution along the way due to capital requirements. This is more like venture capital than anything else, with various funding rounds along the way and a volatile valuation path. In the same way that venture capitalists use position sizing to manage risk, so too should Renergen investors. Those who hoped for an easy path and a quick buck with a big portion of their portfolio just didn't do their research. They bought the headlines and the hype. And this is a story as old as time in the markets, and certainly not just in South Africa. If you want a good example of this overseas, Cathie Wood's ARK Innovation ETF is perfect. If you think Renergen did a great job of hyping up the market, you ain't seen nothing yet. Cathie Wood and her team were quite happy to put absolutely outrageous forecasts into the market, attracting capital at the height of the pandemic and deploying it into marginal tech stocks at daft valuations. Today, the share price of that ETF has lost 2% over 5 years. The peak to trough is a drop of roughly 75%. Now, the lesson here is that you must always do your own research, rather than relying on headlines and what you saw on social media, my work included. Those who did that on Renergen aren't surprised at how much capital the company needs to raise over the next few years because they understood the journey ahead. But of course, where they will get a hideous surprise is if helium isn't produced, although recent announcements from Renergen suggest that it could be imminent. Nerves all round here as bulls and bears battle it out over the Renergen share price. For the sheer joy of contrast, I'll finish off with Berkshire Hathaway. The AGM is famous among investors and with good reason. After the passing of Charlie Munger, Warren Buffett had to face this AGM without his longtime friend and partner, with successor Greg Abel in the seat instead. Talk about big shoes to fill, but he is both willing and able. With my dad joke out the way for the week, I'll point out something that absolutely is not a joke: the share price over 5 years. While market newbies were shouting at experienced folk about how they know nothing and don't understand the stuff in the ARK ETF, Berkshire Hathaway casually returned over 100% in 5 years. That means you've doubled your money at a time when others have lost 2% with ARK. Big chunks of the portfolio are really old school names like American Express, Bank of America, Chevron, Coca-Cola, and other names you'll recognize. But the biggest position by a country mile is Apple, which is where the risk might be to outperformance by Berkshire over the next 5 years. My view is that Apple has a good chance of underperforming some of the other big tech names, which is a topic that I covered in Supernatural Stocks last week, so go check it out there. But thanks to the banks, energy stocks, and other exposures in Berkshire, I still think this is a sensible inclusion in an offshore equity portfolio, and I certainly sit with a position in Berkshire Hathaway. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in Supernatural Stocks should be taken as advice.